It's been a year full of macro and geopolitical headwinds, yet emerging market equities, especially Asia, have shown remarkable resilience after what many consider a lost decade. Structural growth in AI has played a major role, with Taiwan and Korea benefiting significantly as the backbone of global semiconductor supply chain. China has also emerged as a key driver. While initial momentum was AI-related, particularly after the DeepSeek moment in February, we are now seeing a broader recovery across sectors, both offshore and onshore. Looking ahead, EM's valuation discount to developed markets like the US is creating a strong case for outperformance, and we continue to see attractive investment opportunities. China, on one hand, remains a widely debated market, but areas aligned with the government's new 5-year plan, like AI, are showing promise. Taiwan and Korea may face short-term volatility, but the long-term visibility has improved. India, though less popular this year due to slower growth, could see renewed interest as GST tax reform takes place and its relative underperformance opens up value. Now, Henry, what are you seeing on the fixed income side?
On the fixed income side, EM and Asian bonds have continued their outperformance to global peers, having benefited from solid economic growth, improving corporate fundamentals, and favorable supply dynamics. A potential US slowdown, Fed easing, and de-dollarization will further strengthen the outlook, while we continue to see EM and Asian issuers invest in infrastructure, R&D, and capacity expansion to drive future development. We're also seeing future, stronger macro frameworks and growing institutional stability, which will underpin resilience during risk-off episodes and provide a more stable operating landscape for issuers. EM corporates are entering this environment with low leverage, healthy interest coverage, and improved financing access, thanks to deepening local bond markets, supporting the outlook for EM and Asian credit. One growing opportunity: local currency bonds. Easing inflation pressures will allow more accommodative policies from EM central banks, creating a favorable backdrop for investors. Now, Proksa, everything sounds very good, but where do you see the risk for 2026?
Indeed, risks remain. Geopoliticals and trade tensions are still risks to watch heading into 2026. Tariffs have stabilized for now, but they are still a source of uncertainty. We also need to monitor how rising supply chain costs could translate into inflationary pressures. These factors could influence sentiment and pricing across the region.
Despite the challenges, EM exposure continues to be a relatively compelling opportunity for investors seeking long-term returns and diversification. Asia in particular provides a compelling balance of growth, stability, with growing local demand helping to mitigate downside risks.